The tax collection system plays a critical role in enabling governments to function and provide essential services to society. It involves a series of steps: assessing taxpayer liability, collecting payments, and enforcing compliance. Governments use sophisticated systems to track income, expenditures, and economic activities to ensure accurate tax assessment. In many countries, individuals and businesses are required to file tax returns, which are reviewed to determine the amount owed. For example, in a progressive tax system, those with higher incomes pay a higher percentage of their earnings. Collection methods may include withholding taxes from income, self-assessment, or estimated payments, particularly for freelancers and businesses. Enforcement is also crucial, as tax authorities conduct audits and impose penalties for non-compliance to ensure everyone meets their obligations. Taxes come in various forms, each addressing different aspects of economic life. Income taxes are perhaps the most common, applied to both individual and corporate earnings. Corporate taxes are based on company profits, meaning that businesses contribute directly to government revenue. Sales and value-added taxes (VAT) are widespread and impact consumers, as these are embedded in the price of goods and services. For instance, VAT is imposed at each production stage, reflecting the value added at each level before the product reaches the final consumer. Property taxes focus on land and real estate values, forming a crucial revenue source for local governments, especially for funding community services and infrastructure like schools, roads, and parks. Excise taxes, sometimes called sin taxes, are imposed on specific items like alcohol, tobacco, and fossil fuels, often for dual purposes: revenue generation and behavior modification. Import or tariff taxes are levied on goods entering a country, which protects local industries and generates revenue from international trade. The structure of tax rates can significantly influence economic behavior. Progressive income tax rates are structured so that higher earners pay a larger percentage of their income, helping to address inequality. Flat tax systems, on the other hand, apply a single rate to all income levels, simplifying compliance but lacking a redistributive effect. Corporate tax rates vary globally, with some countries implementing lower rates to attract foreign investment and foster economic growth. Sales tax rates can differ widely within and between countries, with regions sometimes setting additional local taxes to meet their budgetary needs. In some cases, tax systems include preferential rates, exemptions, or tax credits for specific groups, such as low-income individuals or families, to alleviate financial burdens and stimulate economic participation. Excise tax rates are often quite high on goods considered harmful or environmentally detrimental, discouraging excessive consumption and aligning with health or environmental policies. Taxes serve multiple essential functions. Primarily, they generate revenue that allows governments to fund public goods and services like education, healthcare, law enforcement, defense, and infrastructure projects that benefit society at large. In this way, taxes redistribute resources to support the general welfare, enabling governments to invest in the well-being and economic opportunities of all citizens. Redistribution is also achieved by taxing higher incomes at higher rates, which can help reduce wealth gaps and promote a more balanced society. Taxes can also incentivize or discourage certain activities. For instance, tax incentives might encourage investments in renewable energy or research and development, spurring innovation.